Buying a home in 2026 looks easier than it did 2 years ago. Listings are rising, some prices are being cut. Sellers are actually negotiating again. But that is exactly why so many buyers are walking straight into traps they never see coming. Here's what this video is actually about. Most people think the biggest home buying trap right now is high mortgage rates. But that is not it. The real trap is buying a house using 2021 logic in a 2026 market. A home can look cheaper on the listing page and still become far more expensive after you close. We are going to break down every major trap one by one so you understand the full cost before you sign anything. Let's start with the one that surprises the most buyers, the closing cost shock. Most buyers save for the down payment and think they are ready. But the down payment is only part of what you need to actually close. Closing costs typically run 2 to 5% of the loan amount. On a $350,000 loan, that is $7,000 to $17,500 in fees alone. And that does not include prepaid taxes, insurance, the inspection, the appraisal, moving costs, first repairs, or furniture. So a buyer who thinks they need $42,500 for a 10% down payment on a $425,000 home may actually need $55,000 to $65,000 just to get to the finish line. The down payment gets you into the deal. Closing costs decide whether you can finish it. But here's the trap that catches people even before closing. The loan estimate trap. Most buyers only compare interest rates between lenders. That is a mistake. The real comparison lives inside a document called the loan estimate. It shows your monthly payment, your closing costs, your cash to close, whether your rate is locked, whether the loan is fixed or adjustable, and whether you are paying discount points. The cheapest advertised rate can become the most expensive mortgage once you factor in origination fees, prepaid interest, escrow deposits, and mortgage insurance. The CFPB says you should request loan estimates from multiple lenders and compare them line by line, not just the rate at the top. The cheapest looking mortgage can become the most expensive mortgage once the fees are included. That is important, but if you do not also understand this next one, you could be setting yourself up for a payment shock in year 3. The builder buy-down trap. Builders love to advertise low first-year payments using something called a 2-1 buy-down. Here's how it works. On a $400,000 loan, your payment in year 1 might be around $2,027 per month at a 4.5% rate. Year 2, it jumps to around $2,271. By year 3, when the buy-down expires and you are at the full rate, you could be paying around $2,528 per month. That is $500 more per month than when you started. The buyer felt comfortable in year 1 and never planned for year 3. The first year payment is marketing. The year 3 payment is reality. Now let's talk about the trap that is reshaping entire markets right now. The lower price means better deal trap. In April 2026, the national median list price was $425,000, down 1.4% year over year. Active listings were up 4.6%. 11 of the top 50 metros were already classified as buyers markets heading into spring. That sounds like great news. But a lower listing price does not automatically mean affordability improved. Here is why. With 20% down on a $425,000 home, your loan is $340,000. At a 6.53% mortgage rate, your principal and interest payment is about $2,156 per month. That number does not include taxes, insurance, HOA fees, PMI, repairs, utilities, or closing costs. The price tag is not the payment. The payment is not the full cost, and the full cost is what destroys buyers. Which brings us to the trap hiding inside every monthly mortgage statement. Taxes and insurance are not small details in 2026. A Neighbors Bank study found that property taxes and homeowners insurance account for an average of 21% of monthly mortgage payments across U.S. metros. Using that math, if your principal and interest is $2,156 per month, your real payment is closer to $2,729 per month once taxes and insurance are included. That is $573 more every single month before you add HOA fees, PMI, utilities, or maintenance. In 2026, taxes and insurance are not side costs. In some markets, they are the second mortgage. But it gets more specific than that. The property tax reassessment trap. Many buyers estimate their future taxes using the seller's current tax bill. That can be a serious mistake. When a home changes hands, the property may be fully reassessed at the new purchase price. In new construction especially, the first-year tax bill may be based on land value only, then jump dramatically once the completed home is assessed. There are documented cases of new homeowners seeing their monthly payment rise by nearly $1,000 after reassessment. Do not ask what the taxes are now. Ask what the taxes will be after you buy it. That is important, but this next trap is one most buyers never even think to check: the insurance availability trap. The problem with homeowners insurance in 2026 is not just price, it is also whether you can get it at all. U.S. Treasury data shows that homeowners in the highest climate risk zip codes paid an average of $2,321 per year for insurance, which was 82% more than homeowners in the lowest risk zip codes. Non-renewal rates were about 80% higher in those same high-risk areas. Lenders require insurance, so if you get pre-approved, find a home, negotiate the price, and then discover insurance is nearly impossible to obtain or costs 3 times what you budgeted, the deal can fall apart or your true monthly cost explodes. In 2026, you do not just shop for the house, you shop for insurability. And if you are buying in a flood-prone area, standard homeowners insurance does not cover flooding. That is a separate policy, a separate cost, and a separate risk that many listings will not make obvious to you. The most expensive risk is the one your normal insurance policy does not cover. Now let's talk about a trap that is catching buyers who think they are getting a great deal: the seller concession trap. In April 2026, 16.7% of active listings had price reductions. Sellers are offering closing cost help, rate buydowns, repair credits, and price cuts. That sounds like free money, but the trap is not asking which concession actually solves your specific problem. A $10,000 closing cost credit helps your cash today. A $10,000 price reduction lowers your loan balance, your monthly payment, and potentially your taxes and insurance slightly. Neither is automatically better. It depends entirely on whether your problem is cash to close or long-term monthly affordability. A concession is only valuable if it solves the right problem. And speaking of solving the right problem, save this video before you tour any homes. This is the checklist most buyers wish they had before closing. If you are finding this useful, subscribe to the channel so you never make an expensive decision with incomplete information. Now here is the trap that is brand new for 2026 buyers: the buyer-agent commission trap. Since the NAR settlement changes, buyers must now sign buyer-agent agreements before touring homes, and those agreements define how the agent gets paid. The trap is signing without understanding the commission amount, whether the seller will cover it, what happens if they do not, and whether you owe the agent if you find a home on your own. On a $425,000 purchase, a 2.5% buyer-agent commission is $10,625. If the seller does not cover that, it comes out of your pocket. In 2026, buyers must negotiate their agent agreement before they negotiate the house. That is important, but if you do not also watch out for this next one, you could be overpaying every month without knowing it. The PMI trap. If you put less than 20% down, you will likely pay private mortgage insurance. PMI increases your monthly payment and does not automatically disappear when your home value rises. According to the CFPB, cancellation depends on your loan balance reaching 80% of the original home value, your payment history, and in many cases, a written request from you. Many homeowners overpay for PMI for years simply because they never asked to remove it. PMI is not always permanent, but many homeowners overpay because they never ask. Now let's talk about the trap that can cost you tens of thousands in a single afternoon. The inspection waiver trap. Even in a more buyer-friendly market, some buyers still waive inspections to make their offer look stronger. But an inspection is not just a negotiating tool. It is your one chance to discover what you are actually buying. A roof replacement can cost $18,000. HVAC replacement can cost $9,000. An electrical panel upgrade can cost $4,000. A buyer who waives inspection to win a house and then discovers $31,000 in repairs after closing did not save anything. They just delayed the bill. Waiving inspection does not remove the problem. It only removes your chance to discover it before you own it. And then there is the trap that can hit you 6 months after you move in. The HOA and special assessment trap. Median monthly HOA fees rose to $135 in 2025, up from $108 in 2019. In some Florida markets, median monthly fees are above $500. But the bigger trap is not the regular fee. It is the special assessment. A special assessment is a one-time charge from the HOA or condo association for repairs or capital improvements that regular fees cannot cover. In some aging condo buildings, those assessments have reached tens of thousands of dollars per unit. A buyer who sees a $2,000 mortgage payment and a $450 HOA fee may actually be buying a hidden capital obligation they never priced in. With condos, you are not only buying the unit, you are buying the building's financial history. And finally, the trap that can steal everything in a single moment: the wire fraud trap. Real estate transactions involve large wire transfers moving fast under pressure. Criminals use fake emails, impersonated lenders, and fraudulent wire instructions to redirect closing funds. First American reported that the average wire fraud loss for consumer recovery cases in 2022 was $106,557. The rule is simple. Never trust wiring instructions that came only by email. Always call your title company or closing attorney directly using a phone number you found yourself, not one from the email, to verify every wire before you send it. One fake email can steal your down payment faster than a bad mortgage can ruin your budget. Here is what ties all of this together. The real trap in 2026 is not the mortgage rate. It is thinking the mortgage is the only cost. A buyer should not ask, "Can I afford the mortgage?" They should ask, "Can I afford the house after taxes, insurance, HOA, PMI, maintenance, utilities, repairs, and income shocks?" On a $425,000 home with 20% down, the principal and interest is about $2,156 per month. Add taxes and insurance, HOA, a maintenance reserve, and utilities, and the real monthly housing cost is closer to $3,579 per month. The mortgage is the entry fee. Ownership is the subscription. The safest buyer in 2026 is not the person who gets the lowest price. It is the person who understands the full cost before signing. Drop the city or state where you are thinking about buying in the comments, because the biggest traps shift depending on the market. And send this to someone who is buying a home in 2026, especially if they are only looking at the monthly mortgage payment. They need to see this before they sign anything.